Welcome to the Treasury Capital Markets and Risk session at Finastra Forum in London. My name is Pedro Porfirio, and I am the Global Head of Treasury Capital Markets and Risk at Finastra. It is my pleasure to present to you today. In this session, we will talk about the evolution of banks, how they need software to automate their workflows, and the vicious cycle that we are in today in financial software. We'll show how Finastra can help you break this vicious circle. We'll show you a path where you can make your infrastructure lighter, your access to innovation quicker, your life easier. We'll show you a path where you can simplify things. We'll show you a path where you have choices, where you're not a hostage of your software vendor. Being open means many things. We mean them all at Finastra, and we will show how partnering with open can help you now. So firstly, let's go over our experiences servicing financial institutions. That shows that the evolution of banks is very similar across countries. So, is there needs on Treasury? Small local banks need to access the interbank for loans and deposits to manage their liquidity and use government bonds to increase their interest income. As they grow, they use more capital markets instruments to better manage their interest rate risk, usually by investing in covered bonds, mortgage-backed securities, and longer-dated government bonds. As the evolution continues, and they need to support SMEs, they need to expand their product offering. An example is providing long-dated fixed-rate loans, what triggers the need for interest rate swaps so interest rate risk can be hedged. Offering foreign exchange products to support their clients' supply chain and overseas business is another service that banks' clients usually request. To service even larger corporates, some more sophisticated products need to be offered by the Treasury Department. Secondary trading of fixed income and options on FX and rates have demand. Structured deposits and notes for high net worth clients are examples of more complex offerings. Banks eventually will need to offer investment banking services so their larger clients can direct access capital markets. In this evolution, technology has enabled banks to offer more business and services with their associated regulatory headaches. On top of that, competition from incumbents and disruptors is a constant pressure. These factors increase the need to lower costs, risk, while managing greater volumes. The traditional answer is to automate using software. In order to do that, you need to select the software or select a new module of your current software. After selecting comes deploying, then you need to connect, you need to test, and finally, you operate the software. The more complex the software, the longer the process is. Months, years, long, risky projects. If you go for a smaller software, that means different pieces of software and integration becomes a large headache. You take months to implement a new piece of code to find out that some parts of the ecosystem are not compatible with that. The cycle keeps going over and over. How do you change that? Well, in order for banks to be able to offer products and services we just discussed, banks need to manage ever more complex workflows the financial contracts behind these products entail. They need financial software that supports what we call the front-to-back operations of the bank. How does that work? Firstly, banks need to store the financial contracts and comply with its legally binding obligations, like payments, matching, confirmation, and settlement, with all the postings to the general ledger associated with that. That's what we call post-trade processing, or back office. The information of the current state of these contracts, plus the effects of outside variables, is paramount for the treasurer to decide what to do. The middle office knows where to get information, where to put the information. Let's call it decision support. Mid-office then can provide information that needs to be shown at workstations at front office, so you can make the decisions that are more suitable to your business. This is what we call front to back. But while the financial contract information comes from back office, mid office needs to access additional information, functions and calculations. So mid office needs to run risk numbers, needs to get reporting done, collateral, needs to get pricing, market data, you name it. These are usually additional modules on the front to back software. Or they come from pieces of software that you integrate and need to connect to. Any changes, again, trigger upgrades. And a lot of these changes have to do with the need of new or enhanced additional modules on software packages that are difficult to integrate and operate. Trying to avoid having more and more different pieces of software from different vendors, banks have tried to keep less and less vendors, asking their current vendor to add more and more functionality, making the software package even bigger, feeding in that vicious cycle. Add to that, the sources of innovation are difficult to pinpoint. Can you expect a single vendor to provide everything you need in that big piece of code? Not really. So you can make the point the banks are stuck. You can get a large piece of software and suffer from lack of innovation, long implementations, or get more vendors, have more access to innovation, and suffer from long projects and incompatible interfaces. So far, this has been the only two choices you have, until Finastra Fusion Fabric.cloud. How does that work? The idea is simple. Imagine you have a new piece of functionality you need to add. We all know the rates are moving higher, inflation is around the corner, so you want to use interest rate swaps to manage your risk. Regulations now mandate you must post collateral on your derivatives trades. So you now need to manage a whole new collateral workflow process. Instead of adding another piece of software, you need to select, deploy, test, and operate. Again, you go into the vicious circle. Imagine you can get the managing and posting of collateral given to you as a service by people that are experts on that. Imagine you can add that or other pieces of functionality as a service from a vibrant ecosystem of fintechs using a common platform that connects your core to the fintechs. This platform exists today. It is FusionFabric.cloud. New functionality, innovation that can be consumed with no or little footprint on your infrastructure. Using APIs or for smaller amounts of data and time frames in seconds and milliseconds, or with larger data sets for gigabytes, terabytes of data when you need large amounts of information, the connectivity, the architecture, all that information is public. So fintechs, SIs, universities, basically anyone can have its offering pre-integrated with your front-to-back core. Let's check an example with risk as a service.
Calculating risk is a fundamental part of a bank's day-to-day operations. From enabling successful trading activity to complying with regulations, banks need access to robust risk calculation solutions to function. Until now, banks have been able to get the functionality they need through vendors like Vector Risk, who can provide cloud-based risk calculations for trading books. However, this process requires the bank to obtain and manage the financial information coming from their market data provider and be set up to send trade and financial information to the risk calculation vendor. Implementation can take months. Furthermore, the process isn't scalable, so it needs to be rerun each time a fintech wants to access the data. Using Finastra's FusionFabric.cloud open platform, banks can now be live in days and consume risk measures in minutes thereafter. Here's how it works. The bank and market data provider upload their trade information and market data into FusionFabric.cloud using an upload app, a simple data extraction process. Vector risk consumes the information from the platform, generates reports, and calculates risk measures. The bank can consume these risk measures either from the platform or directly from vector risk screens or download files. No point-to-point integration needs to be done between the bank, data provider, or fintech. Using an open platform provides additional benefits. Market data, verified by the data provider, can also be used for end-of-day valuation of the books and price verification from auditors. Implementation can be done in days, as cloud-based risk solutions are pre-integrated with data share. The data in the Fusion Fabric.Cloud data share can be used by other fintechs in the ecosystem, greatly expanding the capabilities and functions it can provide. Consolidating trading books and banking book risk is possible via the data share. For more information on how to access vector risk via Fusion Fabric.Cloud, visit www.fusionfabric.cloud.
So simple. The data is sent to Fusion Fabric.Cloud. The data set structured and format published on the Fusion Fabric.Cloud website. Everyone knows how it is. The bank has full control of the information and decides who to make that information available to. If the bank wants, it subscribes to risk measures and makes the data available to vector risk, who can run the data. So vector risk consumes the data and generate the risk information and risk reports with the level of granularity needed. The pricing models, the risk models, all the information is available to the bank. And you do that with no project plan, no long implementation, no black boxes, no surprises. What you need when you need. You want another example? Let's check how it works with Collateral using CloudMargin. As you can see, the slide doesn't change much. Collateral is a service. You make the data available, the fintech consumes the data. Not difficult to imagine regulatory reporting and other types of services. Not difficult for you, Treasury, to imagine how you can have your core banking data exposed and having AI and big data and a lot of these fintechs that exist out there to help you out. But what do fintechs think about this? Right? Why would a fintech join the ecosystem? What is in it for them? So in order to clarify that, we have here Simon Millington from CloudMargin. And Simon, can you please tell us what you think about this whole new business model?
Absolutely, Pedro. So look, ultimately, from a service provider like CloudMargin, the fact that FFDC is there to take data out of core banking systems and make it available to us as a vendor makes things much, much more straightforward from an implementation perspective. So as a cloud-based collateral management provider, we're often talking about sort of weeks to months from an implementation perspective. And that is kind of versus a kind of implementation timeframe of kind of quarters, 2 years. So we're already, by being a sort of cloud-based collateral provider, much, much better equipped than our competitors. However, with a service like FFDC, Fusion Fabric.Cloud, we can really, really shrink that implementation time much further down than that. So we're massive, massive advocates of this type of service. That kind of open ecosystem concept that you mentioned as well is something we're very supportive of.
Thanks, Simon. Thank you very much for that. So, one word, simple. With Finastra, you can simplify your treasury, capital markets, and risk infrastructure. Fusion Opics, Fusion Condor, Fusion Summit can all be connected to Fusion Fabric.Cloud, FFDC, if you choose to do so. You can start your journey now. First, by consuming functionality using apps. Second, by simplifying the core. Right? And you can simplify the core by removing or adding additional functionality using, we have close to 200 apps on the store now. Pick what you want as a service. Get your core lighter. We will continue the journey to make it more open and more robust. So moving to managed services on the cloud becomes easy. You don't need to do the big bang. You don't need the big blob of software. It's much smaller. It's an evolution. and we can do it, you can do it with Finastra. Treasury as a service is possible today with Finastra. And this is possible because we're open. We're open to partners, we're open to fintech, we're opening or bringing you choice. Thank you. So now we have a very interesting Q&A section with Pradeep Bhaganna from ITC Infotech, and again, Simon Millington from CloudMargin, where we're going to be talking a little bit about what is it to be open, what's the impact on you, the banks, and system integrators and fintechs and everyone in the ecosystem. So Pradeep, we just talked here about being open and being open for business, and the main reason for that being that banks have a hard time integrating and running these big systems. I mean, given your extensive experience on Treasury capital markets and implementing software, can you share some of your thoughts with us on what is the Finastra, about Finastra's strategy?
Sure. See, based on the experience that we come with, ITC Infotech, we have been a part of around 100 plus implementation on Treasury and transformation engagements. And going by the experience, we believe that SaaS Treasury solution that Finastra offers is probably going to benefit the bank in quite a few ways. First and foremost, it's going to be reducing the cost. A SaaS solution always comes up with a lower upfront cost than on-prem solution. It does not need large capital expenses for infrastructure or physical facility. It is faster time to market. Implementing an on-prem solution requires coordination and collaboration between the bank's business teams, technology teams, IT infrastructure teams, the product vendors, and so on, often resulting in a longer implementation cycle. A SaaS implementation with a ready-to-use, pre-configured solution will need a shorter implementation cycle. Also, the up-to-date infrastructure and software is another benefit. A SaaS solution will ensure continuous evergreening of the platform and the infrastructure, enabling banks to keep pace with the changing technology and deliver innovative products and services. It's always easy to scale, so it's easier to add more capacity to scale in a SaaS solution through a subscription-based model or a pay-as-you-grow model. The increase in operating expenses is much smaller when compared to scaling an on-prem solution, and it is more predictable. The costs are more predictable. It also results in an improved customer experience. Cloud enables banks to offer a new range of digital services, providing superior customer experience. Last but not the least, it brings in resilient operations. Cloud allows remote access, thus enabling treasury operations to reap the benefits of mobility and ubiquity.
Thanks, Pradeep. That's great insight. Now, if you talk about partners and managed services and people operating, other people operating the system, or the system being on-prem, being operated by the bank, or on the cloud, being operated by the bank or by a partner, I'd like to ask Simon, what are your thoughts? How does that impact CloudMargin, and do you think it's the benefits of using Collateral as a service is the same on all these different types of deployment?
Yeah, so absolutely, Pedro. So from a CloudMargin perspective, we've always been about sort of allowing clients to build their own sort of ecosystem from a data perspective as well to other sort of specialist vendors as much as anything. But the challenge and the kind of limiter for a lot of clients doing that is actually that sort of connectivity element that you kind of talked about quite a lot earlier as well. So from our perspective, anything that kind of aids that easy connectivity to core banking systems between core banking systems and other sort of downstream processes like a collateral management workflow solution is just incredibly helpful to kind of guide that. So from a technology standpoint, look, we speak to a lot of our clients and the technology departments within those firms, and they're super excited to always be dealing with sort of the latest and greatest technology. Even APIs, cloud-based solutions, they're incredibly open to that as well. So we do have some detractors when we talk about this type of solution, and a loss of kind of control and ownership. But then they're able to sort of focus on the sort of value-add activities around that. So it's a good kind of starting point a lot of the time for that kind of modern technology initiative.
Thank you. When we talk about what's happening with banks and adoption of cloud and cloud services, I still get a lot of questions about security and the position of the regulator. And I mean, Simon, you have over 100 clients now using your service, and it's cloud-based, right? Can you elaborate a little bit what jurisdictions you're at now, and what are the challenges, and if that's a misconception or there is really a fundamental problem with regulators with cloud stuff?
Yeah, absolutely. So we're actually now over 150 customers. So we've managed to convince a number of sort of financial institutions globally. So we're on 6 continents as well. That this type of solution is the type of thing that they should be going for. And obviously, from a small vendor perspective, we've had to sort of jump through a lot of hurdles to kind of get to there, so that clients are comfortable with a cloud-based solution, the security that goes alongside that sort of solution as well. But all of them have now kind of started to adopt that type of technology. Look, I think in terms of regulators and sort of global jurisdictions, everyone is slightly different around this from what we've seen, but regulators are coming out and actively supporting this type of technology now. In the US, you've got examples of military contracts going to the sort of big cloud-based solutions as well. So there is support from local regulators plus governments for this type of solution as well. And so I think we'll only see the use of cloud-based technology expand.
Thank you. Pradeep, from your standpoint, right, when you talk about what ITC Infotech does and doing a managed services, you mean getting, let's say, the core system, let's say a Treasury solution, let's say you got Fusion Condor, and putting the Fusion Condor on Azure, putting it on the cloud. What do you think are the challenges that a bank will have on that? What are your thoughts about that?
See, I think the most challenging thing that a bank will have is probably being open to adopting cloud infrastructure. I think as we just now discussed, most of the banks are apprehensive about a multi-tenant architecture. I think security is of the prime concern out here. So I think there are ways in which probably these can be addressed. I believe that one has to take a very holistic approach to security. There are measures to eliminate or reduce the security risk, and they can be broadly classified into 3 categories. Governance, control, and auditing, which revolves mostly around segregation of duties. Basically, the goal is to define clear roles and responsibilities in order to reduce or eliminate conflict of interest. A single individual has the power or the capabilities beyond those defined for the roles. And next comes a configuration, design, or a change management. Let's take an example. In a SaaS, each hosted application instance shares a single instance of object code. So when there's a mistake made or the code corrupts in memory, potentially millions of clients may have access to private data of other clients. So one of the ways of mitigating this risk is by developing a SaaS solution on an aspect-oriented program, or AOP. So AOP effectively removes and abstracts the security implementation, protecting data from the core underlying service functionality. Now, this approach allows each client to implement the security measures like encryption, algorithm, cipher strength, authentication, or access mechanism differently as per their own needs, while still using the same object code. The other thing that comes into picture is about the logical security, access controls, and encryptions. Because typically, a cloud service provider will use an encryption algorithm like AES or a Ballfish or any other industry standard algorithm for the clients. Now, if they're using the same algorithm for all their clients, then there is a risk that the encryption protocol compromised for one client can potentially compromise for all of them as well. Hence, it's important to diversify the encryption mechanism. So there are a couple of options that one can look into, like a predicate encryption, which allows segments of data to be stored and encrypted and decrypted. So the individuals may only have access to that particular segment of data. So a compromise of the individual segment doesn't necessarily mean compromising the entire data landscape. Similarly, homomorphic encryption, this type of encryption allows ciphertext to be processed without the need for decrypting the data prior to processing. So this reduces the opportunity to intercept or decrypt data during processing by a malicious party.
Very interesting, Pradeep. Very technical. Thank you very much. My background is not that technical, but what I like to think is some of these things that we're doing, when you talk about Fusion Fabric.Cloud, one parallel that it did is like WhatsApp encryption. It means that only the two parties that have can see it, and not even WhatsApp can see it. So on that example that on the video on, let's say, vector risk, when you send the data, only you, the bank, can see the data, and you define who else can see it. Finastra doesn't have access to it, cannot see it unless it has the username and password. So it's another way to do it. And I think as well, as you're saying, very interesting, the fact that when you put the core, you have so much sensitive information there, and you're so dependent as a bank that has to be run, that the level of encryption and security you have to do, it's very, very high. So it goes back again to what we were saying before, that if you remove things from the core and start using things like CloudMargin as a service, that because it has no personable identifiable information and it's not considered a primary system in all the jurisdictions that so far we have touched, it means that you can move it now and it's easy and it's rather benign because there's not a lot of bad things can happen. And then your core becomes lighter, and then all those very sophisticated algorithm architecture or methodologies can be applied. So I think this is very relevant on separating, again, looking into our being open strategy that consume things as a service that can be consumed. They are not catastrophic or not that, they're important, but they're not going to make your business go down. I think the regulator is much more amenable to that. And then get your core, get someone from ITC Infotech that knows all the mitigants you can have in terms of security to be able to make the migration for a proper Treasury as a service. Simon, in terms of when you talk about using FFTC, do you see when we talk about this? How can I say? Platform effects, where you being there and us being there allows other fintechs and other banks to be there, that actually makes your offering more valuable, right? Is that something that you think of? Have you seen that happening yet, or you think it's too early to have any practical examples of that?
No, so look, I think absolutely, Pedro. I think from our perspective, the more apps connected to FFTC, the more kind of pilot and example use cases that our customers have around the kind of interoperability of the different services and that easy access to data, it will continue to kind of spiral. So we'll kind of see more of that happening. But yes, look, absolutely, from our perspective, clients are really asking us, how do we integrate our data with you more simply, more easily? Everyone is resource constrained still. We're sort of 2 years down the line from sort of COVID, and people are still kind of working remotely. So if we can make our customers' lives easier by providing that sort of more simple integration between services like FFTC and CloudMargin and others, then we're helping the kind of wider ecosystem.
Thank you. And last question to Pradeep. In terms of COVID and what has been happening in this past 2 years, how has it been the positioning of banks, and not only in Treasury capital markets, but other areas of finance? Are you seeing now a acceleration on moving to the cloud and SaaS and managed services?
Yes, we do see that. See, with the pandemic coming in, I think there is a lot of push for digitization. Right, and there is also cost pressure, so banks are forced to actually reduce the cost. And one of the best ways of doing is to adopt cloud and go into a managed services model. Let the banks focus on the core business and let the teams with the experience come in and manage the solution for them. I think that will be the best approach, and we see a lot of banks going towards that.
And compared to 2 years ago before, do you think COVID had actually accelerated that, or that was something that was going to happen?
No, it has accelerated. It would have happened, but probably the COVID has accelerated it. It would have probably taken 10 years, let's say, for example, to come to this level. But I think with COVID, I think it has fast-forwarded that adoption. So I think every bank or every financial institution is pushing for a SaaS-based solution or for digitization of the services.
Thank you.
aggressively.
Thank you very much. So I guess, I think we're getting to the end of the Q&A, of this interesting discussion, not really a Q&A, more like a discussion. I think what's important for us to take is that, software as a service, and in many shapes or form, starting with managed services is something that's a trend that's coming. It's safe. There are many ways for you to protect your data. The regulatory environment is becoming more and more benign to that type of offering. You have as well some offerings that are less critical to you, like collateral risk that you can actually use as a service now, so it's easier for you to start making that transition. We've seen that COVID has accelerated that. A lot of banks are taking advantage of that acceleration. And if you're not, maybe you should be talking to us about it, and we can help you out with that journey. So this has been really, really great. Thank you very much for attending. Simon, thank you very much for being in person. Great to see you.
Thank you, Pedro.
And Pradeep, I'm sorry you couldn't make the trip, but some things are outside our control, aren't they?
It's a pleasure. Thank you.
Thank you. Thank you very much. Have a lovely day.